Today we are going to analyze the company called Wix.com. It is a company that creates websites. I don't know if you guys are familiar with Wix.com. Maybe you have used it.
I've used it, and in general, basically my son has a startup, and he used it as his principal web page, and it apparently seems to be the best alternative in terms of price quality, and to make websites and to integrate, I guess, the different issues around a website, and like marketing online, etc. So it seems to be very user friendly. Those are the comments that I've heard.
That's true. Vikram, we are talking about Wix. Hi, Vikram. Good morning.
Hello. Yeah, good morning.
So here in this call, a few people have tried the Wix, but nobody has analyzed the business. I used to have some websites on Wix. The first thing we want to do in our analysis is to see if we understand the business model, right? I can show you the template. I mean, this is your first call, guys. So let's have the right structure. This will be the complete research process. I can maybe download it and zoom in. The goal is, the step number one is to see if we understand Wix. And if we understand Wix, we'll go and look into the numbers. First, do you understand the business? If yes, you analyze the numbers. If you don't understand the business, it's a pass and you move on. Well, normally we should understand the business. It's just a business that helps you build websites, so that's fine.
By the way, if you want to outperform the market with a proven investing strategy, I've created a free guide that shows you how to do it step by step. Just comment guide below and I'll send you the link to access it on demand.
Okay, so why don't we start? A good way to see if you understand the business model is to go to their website, right? It's a good, if you go to the website of Monster Beverage, you will have that. They will have a simple product. They will have a few ranges of cans. So that could be quite interesting. For Wix, we all know the company. My big question when it comes to the business is, do they do something else? Or is it just a tool to create websites? Okay, what do we have? Products, website design, website templates. Also, either you can create your own website from scratch, or you can just have a template, a plugin, and just put your title. AI website builder. Yeah, another question when you sent me this message, Vikram, was, will it be replaced by AI? The same threat that we have for Adobe. Now you have the small competitors from the Silicon Valley that can completely crush Adobe and Photoshop, like a small AI tool completely for free that can add images and you can completely copy Photoshop. Maybe for Wix, we have a big AI threat. So like Adobe, they are implementing AI. Is this enough? I don't know. What is that? Business? Okay, so this is for creation. This is for business, e-commerce, blog, scheduling, portfolio. It seems like this business is easy to understand.
Mm-hmm.
Another way to check if you understand the business model would be to check the investor presentations of the business. This is my go-to resource. Usually I go to FinChat, I click on investor relations, and I go to the latest quarterly update, and there are some slides. In case you don't have FinChat, guys, you just type wix.com investor presentation. You can type investor relations. You just have to go to there. Look at this, investor relations with all the documents, all the transcript, and you try to have earnings slides. Here we go. So in case you don't have FinChat, it's easily readable. Okay, we have 28 slides and we can start. Okay. In case you have any questions, guys, don't hesitate to interrupt me. I'm about to speak for 2 hours straight, but if you don't understand something, if you have a question, please interrupt me. Sometimes I see you, sometimes I just don't see you. So feel free to do your own research. Maybe you can open a new tab and do the research at the same time in parallel, or you can just enjoy the ride. Vikram is enjoying the ride. Look at him like this. It's early in the morning.
Yeah.
That's normal. Okay, company overview. Is this a recurring business model or just a license that you pay? Registered users, 300 million users. That's a lot, including the free one. Creative subscription recurring revenue is $1 billion. Employees this. Percentage of revenue outside North America, 40%. It's available in a lot of countries.
Yeah, this is based in Israel. This company, it's not based in US.
Oh, okay. Israeli company.
Yeah.
Good. Okay, that's a tech-heavy country, so okay. Where any business person can create their dreams online. Okay, come on. We believe that Wix is becoming the primary platform for every type of online presence around the world. Yeah, basically you create websites. Okay. The goal of investor presentations, when we look at slides, we want to see what they do, maybe some images of their product, services. For example, if you look at John Deere, you will have tractors, something for farmers. It's much more visual. And the goal is also to check the charts, graphs, like this, for example. You don't see a lot of volatility in their revenue. You see straight lines up and to the right. What's that? It seems like you have a light blue and a dark blue. Business solutions, creative subscriptions. Seems like this business has two segments. Okay, and which one is the bigger? It's bigger. This one is so hard to differentiate the two.
Yeah, the darker one is, I think creative one is.
That seems like creative is darker.
Yeah.
So creative is $300 million of revenue. Business solutions is 100. Which one is growing the fastest? We don't have the data. Do they have the same margins? I suspect the margins are the same. This is a software company. So normally for software company, guys, look for a gross margin around 80%. Software asset-light business models. And similarly to what we had on Wix, on their website, creation business. Creation is where all the revenue is made, and now you have business. Is the business segment new? Is this an old segment? Nobody knows. So this was on a quarterly basis, basically up and to the right. I like recurring business models because you have recurring clients. You just have to increase your prices every year, like Netflix or Spotify, and people will pay if your product is great. And this is on an annual basis at the right of the screen, up and to the right. You don't have volatility. After this, we will go to Guru Focus to check the last 10 years. Just after this, consistent creative subscriptions, more subscriptions. That's the ARR. So that's not the number of subscriptions. That's the revenue run rate. Revenue run rate is up and to the right.
So quick question. So what is the revenue? What's the ARR, like run rate? Like it's not the total revenue, or like is it something else?
I suspect, I will check the definition.
It's annual recurring revenue.
Yeah, that's your recurring clients times the price point. So what you can get for sure on a recurring basis annually. Annual recurring, yeah. That's nice, Kenneth. You know more than us. Total bookings. What's that? Again, these two segments. Okay, so I suspect that there are only two segments. What's the difference between bookings and revenue? I don't know. Similar chart. No, you see more volatility when it comes to bookings. Are bookings subscriptions? I don't know.
It's probably before it becomes a revenue, right?
Oh, when people sign up to the website?
Yeah, something like that. That's what I imagine. I don't know.
Okay. And this is growing similarly year over year. Tremendous partners momentum. Partners revenue. What's the definition of a partner? Look, here you have the note. Partners revenue is defined as revenue generated through agencies, freelancers. Okay, like B2B business, people that want a website for business, agencies, and B2B partnerships, Vistaprint. Okay, so not individuals that create websites, but businesses that create websites. And this is growing, obviously. Transaction revenue growth, everything is growing, okay. Increasing monetization of user cohorts. Oh, what's this chart? A cohort must be where did you join Wix.com? Where did you start using their products. What can we check? This is on people that started using Wix.com since 2010. I think this chart, this is the first time I see this kind of chart. It just shows that their prices have increased over time. And what's that? That's the number of months. I don't have the reference here. Is this the number of months? I don't know, not sure. Cumulative bookings. Seems like, if I understand correctly, it shows that the more recent the data, the more the sharper the price increase. So when they started, when they were a small company, they didn't have much pricing power. So the price increases were small and small and cumulative and small. Now you can increase the price much more rapidly. Could be sign of, this chart could be a sign of a moat, by the way. Because if we see a competitor to Wix.com, maybe you can check what is the price evolution over time. Maybe for competitors, you don't see this chart. You only see one chart over time. They don't have the same pricing power. Okay. Efficient marketing based on ROI. What's that? On-time marketing, ongoing bookings, marketing cost. Yeah, okay, let me skip it. Existing cohorts are a growing source of future bookings. Yeah, you are a recurring business, so your recurring clients will stay here in the future. And they expect more recurring revenue over time. Okay, no surprise here. Okay, North America, 60% of the revenue. On the latest data, that is growing plus 15% year over year. This is the investor presentation from the end of 2024. So AI was there, and still they are growing plus 15%. Latin America, this is 4% of the revenue. This is insignificant. 4% is not a lot. Europe is growing similarly. That's 25% of total. And Asia and others, 11% of total. Okay. Okay. North America, Europe. You don't see a lot of currency headwinds over there. Okay, next slide. We are almost at the end. Increasing revenue retention. What is that? 100% net revenue retention. Seems like they have 10 slides to tell us the same thing. Like they have recurring clients that are going to pay more. Okay. Global strength of the Wix brand and focus on operational efficiency. What's that? Non-GAAP gross profit. Non-GAAP SM. Social and marketing expense. What's S? And non-GAAP. Why do they specify non-GAAP? From what I've seen, I've checked Wix a couple of weeks ago. They are not profitable on a GAAP basis. Like the real numbers are negative. They are not profitable. So maybe they trick their accounting and they focus on non-GAAP profits because they don't have any profits.
Sorry, Chris.
Yep.
Can I ask you what is a GAAP and non-GAAP? And I'm not sure to follow there.
GAAP
Sorry.
is generally accepted accounting. P is procedures or something like this. Profits. GAAP is official number. In the world, you have international rules. You have to put your revenue minus cost minus etc. etc. And that's your net income. That's the official rule, like the way we are taught at school. But some companies are not profitable. Like the GAAP official net income is negative, but they want to look good. If you have some slides like this, you want to look cool to your partners. You want to be appealing to your shareholders. So you trick the numbers a little bit, and you say, that's not the official numbers, but look at us, we are growing and profitably. So you basically cheat, and you say that you are profitable on an adjusted basis. Non-GAAP means adjusted.
But still, then you can find the gap somewhere.
Yes, we will see the numbers and you will be disappointed. Yes, GAAP meaning the P, generally accepted accounting principles. Normally, at the end of these slides, you will have the real GAAP net income, and
Okay.
the reconciliation with the non-GAAP, like the difference. Normally, people, the difference between gross profit and non-GAAP gross profit, people can add back the depreciation and amortization, can add back the cost of stock options. Some companies say that stock options, when you give shares to your employees to have like a gift to them, they say it's not a real cost because it's not a real salary. Okay, so they add it back. They can manipulate data like this.
Now you said, Christophe, that they weren't making money, but I was looking at FinChat, and 23 they have a diluted EPS of 0.58, and 2024 was 2.3. So maybe this is you can declare an EPS under this principle of non-GAAP. Then that would be true.
Yeah. For example, was this company profitable 10 years in a row? No, they were unprofitable, and then for the last 2 years they have become profitable.
Right.
Okay. Yeah, I mean this.
That's what I'm looking at in terms of the diluted EPS, which is like the key factor I use in my valuation for the standard, companies.
Normally you use GAAP like this.
And what I'm looking at is that they have in 2023 0.58 EPS diluted, and 2024 2.3. So they're making money now, I would suppose, under that consideration. But like you say, before that, it was pure loss.
Okay. To give them the benefit of the doubt. Now, in this slide, in the latest data, as you rightly said, they are making money. But to give a clear picture of their vision for the business, you want consistency, right? You want these nice looking chart to reassure your shareholders. Like, here is the smooth ride we will take. If they had used GAAP numbers, it would have been red, negative, and then 2 years in a row, that's a plus. I mean, you have no visibility if you did this. So you, how do you say it? You smooth things out if you use non-GAAP. Some companies, this is their argument. Like to give them the benefit of the doubt, you can say, yeah, this is why you use GAAP and you smooth things out, nice chart, so you can forecast for the next 3 years, 5 years to reassure your investors.
Because conceptually, if I understand what you're saying, clearly this is a company that has preferred to grow versus profits, right? It's in that stage of the company, and they did that basically with losses until the last 2 years, and that's where clearly it's not the typical company. What I usually use is the 5-year average, right, for financial indicators, and in this case you would have a company that you're playing much more the growth than the history, right?
Yeah, we're not at this stage. We are at step one of the analysis.
Okay.
I mean, we will look at the numbers after, but the revenue, the margins over time. Okay, let me skip it so we can go through Guru Focus and see the fundamentals. It will be fun. Okay, let us continue. So non-GAAP, this was your explanation. You want to smooth things out to reassure investors, etc. And similarly, if their GAAP numbers are a mess, you will always use non-GAAP. And it seems like this is what this company is doing. Non-GAAP gross margin up and to the right. The problem we have with non-GAAP numbers is that you can play around with your adjustments. You can adjust for whatever you want, basically. So what's that? The non-GAAP gross margins are in blue. That's 70%. Okay. I told you it's around 80%. So we feel in this category. What's that? Non-GAAP creative subscription gross margin. We said that there is a creative segment and a business segment. For the creative segment, it was their biggest segment, like $300 million. And because it's a recurring business model, it's normal. You have very high margins for a recurring software business model. And what's that? Non-GAAP business solution gross margin. They don't say it's recurring. They don't say subscription. So maybe when you are a business, you pay upfront once, and that's it. And when you want to be a creative subscription guy, you pay on a recurring basis. So maybe this has two parts. Non-GAAP OPEX percentage of revenue. The percentage of operational expenses, salaries, administration costs, for example, is decreasing. But okay, let's do that after. Free cash flow. Okay, free cash flow is more important than earnings, I would say. That's the real cash after the adjustments. What can we say about the free cash flow outperformance? Seems like this company has always generated free cash flow. It is pretty good. And in 2023, everything accelerated. Okay. Surpass the rule of 40. Yeah, okay. Let me skip it. Here it is. Charles, we have the reconciliation between GAAP and non-GAAP. What can we say? What can we say? What can we say? Gross profit. Where is the GAAP? Where is the non-GAAP? Okay. Okay. They don't show us the GAAP. I'm looking for just a GAAP gross profit. Oh, but that this one. They don't write GAAP. They just write nothing. They just write gross profit. So if you want to see the difference, the reconciliation between GAAP and non-GAAP, for the gross profit. So gross profit is revenue minus cost of goods sold. That's at the top of the income statement. You get your gross profit. What do? You add back share-based compensation expenses, what we suggested, like SBC. You add back acquisition-related expenses. What's an acquisition-related expenses? We really don't care. We are talking about peanuts. That's not really big numbers. And you add back the amortization. Okay. So the difference is not that big, actually, between GAAP and non-GAAP. Okay. Very well. So the margins between GAAP and non-GAAP are not that different. Here we are, gross profit for creative subscription. For the recurring part of the business model, that's 80% gross margin. That's great. And for the business solutions, that's only 20-30% margin. I don't know why. This is a software company. Maybe for the business part of their operations, this is not a software. Like they do the website for you, maybe. I don't know. Okay, so we got plenty of information, recurring, 2 segments, geography. That's why I love investor presentations. You get a company that has been here for more than 15 years now, that has improved their pricing power over time, that is now producing some free cash flow, but is not profitable on a GAAP basis. Okay. What we can do right now is, okay, just for the sake of the exercise, in case that's not clear for you, after you've gone to their website, you don't understand. You watch, you read the investor presentations, the slides. If you still don't understand, the next step is to go to their annual report. We will not go to the annual report, but just for the sake of the exercise, you go to their latest data. Any annual report will do the work. You click on this one and you have company overview. You have a paragraph at the top of the document. Maybe I can SEC filing, quarterly results. I don't want quarterly results. Annual filing of 2023. Annual filing. I mean, come on. Is it this one? Yes, that's a big document. We are talking about hundreds of pages. And normally you have a document, a paragraph explaining what the business is about. Okay, so all the risks, etc. We will not do it, but for the sake of the exercise, this is a good document to find more information. Okay, now we are going to go to the fun part. If we go to our template, guys, if we understand the business model, yeah, kind of, analyze the numbers. Goal focus, you can also check ROAC.ai or macro trend. I know, guys, that you joined a few days ago, so maybe you have not watched all the videos, but on these videos, in these modules in the classroom, I'm showing you how to use these websites. So I will just show you here. Are you following for the moment?
Mm-hmm.
Okay. Let's go to Guru Focus. It's a company in Israel. You're right. What do you say? Wix.com is a software as a service content management system platform that allows users to create, customize, and manage websites for themselves or for clients. Wix is best known for its Wix editor service for self-creators, but in recent years has invested heavily and introduced its Wix Studio offering for partners who are agencies and developers. So they have two business models. Wix also offers a range of business solutions such as payment services and marketing products. I don't know what that is. Okay, let me go to the charts really quick. Let's see. All the metrics that you see on Guru Focus are GAAP, so without any adjustments. What you see is pretty clear. Kenneth, you are completely right. This is a company that favors the growth in revenue in blue. This is just wonderful since the company was created. And the net income is a complete mess. Okay. Some people would stop the analysis here because they say, oh, I only want to invest in profitable business. I am in their camp of only investing in companies that have been profitable for years and years and years. Now that's a different situation, and you invest for the growth. So net income is totally different. About the cash position and the debt position, I see no problem over here. No major debt problem, and they have cash, so that's fine. Now about the operating cash flow. Cash flows are better. Operating cash flows improved until 2019 and then decreased. Just so you know, in 2022, all the software companies collapsed and the earnings collapsed and they had to fire a lot of people. If you work in the tech industry, you know very well that Meta Platforms fired a lot of people. All the big tech giants fired a lot of people, and I suspect Wix suffered at the same time. Free cash flow is similar. Free cash flow is shooting high. And look at this. This is this slide about the shares outstanding. On this small chart here, when you see red, that means the company issued more shares. That means dilution for us shareholders. So for example, in 2017, they issued 5% more shares, which is not good. That's detrimental to the earnings per share. And when you see green, you see a buyback, which is good. So over the years, how did the company survive? Because they are not profitable. They raised the money through public markets. They just issued more shares and got their money through it. So now you know, Kenneth, how did the company survive? A little bit of debt, a little bit of buybacks, and you can survive. And it seems like now the company is doing buybacks, so that's interesting. Let me look on a quarterly basis what we have. Revenue is still going up. Net income is now positive for 1 year and a half. Congrats, guys. I see green. Debt is stable. Cash is stable. The company is delivering more free cash flow. You have this difference between net income that is fairly stable, I would say, net income of $50 million in the latest quarter, compared to free cash flow that is increasing. Free cash flow is more than $100 million. You have a lot of free cash flow compared to your net income, double as much. Okay, we will check what's happening over there. Okay. And what about the operating cash flow? Yes. Okay. So I suspect they have a lot of SBC, and I suspect they have a lot of G&A. That's my two guesses. If I look at the SBC, that's here, this line, stock-based compensation. You will see it in the modules. Maybe it's a little bit too much for this call, but stock-based compensations are stock options that you give to employees. And in the cash flow statement, this is a document like the balance sheet, income statement, cash flow statement. On the in the cash flow statement, you have this formula that deals with net income, some cost, SBC, and the way you get your free cash flow, your operating cash flow, you have to add back the stock options. You have to add back the stock-based compensation. So just, I will finish this one. You start from your net income, $50 million. You add back the SBC, the pink stuff. So you add back $60 million. You have as much stock options as your GAAP net income. That's a yellow flag, guys. That's I mean, I know that's a tech company, but that's a lot. So you do $50 million of net income plus $60 million of SBC, and you roughly get your operating cash flow. Yeah, you add back some amortization, depreciation. So maybe the free cash flow is a little bit too high, because after all, the free cash flow is high, like more than $100 million compared to your net income. That's double as much. But if you don't adjust the SBC, if you remove the SBC of $60 million, instead of having a free cash flow of $130 million, you have a free cash flow of $70 million. Yeah. And if you do a price to free cash flow of $70 million of free cash flow times 4, because that's on a quarterly data. I want to check what's the annual run rate of free cash flow. So $70 million times 4, because there are 4 quarters in a year, that's $280 million of free cash flow. And the market cap is, let's say, $10 billion. I want to check the price to free cash flow, just roughly speaking. So you have 10 divided by 0. That's a price to free cash flow of 35. Okay, decent. And the company is doing some buybacks here. Okay, now the company is not profitable on a GAAP basis. So maybe this chart is not really important, and this chart is not really important. Okay, let me move on. Do you have any questions for the moment?
Yeah, what's in terms of what's the logic on that last indicator? Because, like you say, given that the company is more focused on growth than profit, I guess the free cash flow multiple, or the price to free cash flow, is a good measure, right?
Yeah.
Bet you have. And you said it gave you 35, right? Is that reasonable or not, or what's your?
If the company keeps growing, that's fine. So I don't. This is not screaming expensive at the moment.
Right, but there's something that's inflating that, which is the SBC, right?
No, I adjusted it.
All right, okay, so it was 70, right? You're exactly. So 35 from price to free cash flow is a reasonable range, and for this type of company, you say?
Yeah, maybe. I just took the latest data, and I took the latest free cash flow, removed the SBC to get the real free cash flow.
Right.
Roughly speaking, 70. And it gets us a price to free cash flow of 35. I mean, a price to free cash flow of 35 for a business that can grow by a lot, that's fine. Let me just check what has been the growth rate of revenue. Usually I do this on Stock Unlock. We will use Stock Unlock a lot. You can go to wix.com, go to Freeform, and on this tab, I want to check different things. I want to check the revenue, and I want to check the revenue since 2012. When was the company created? Foundation. Date. 2006. And so they created this in 2006, and they became public in 2013. When you become public, that's a quick tip, you file a document publicly. You announce that you will become public. That's called the S1 document. And in this document, you announce to the SEC, to the authorities, okay, here are my latest numbers for this year and for the years a little bit before. So on websites, you will not get the data since 2013, since the first date of the stock, but you will get a little bit before. So you get a little bit of information before. So we have the data since 2012. And so far, the company has been growing revenue at a CAGR, look at it, CAGR, compound annual growth rate of 35%. Pretty good. And viewers percentage. And on a more recent level, since Pat Dorsey invested in this one in 2018, let's see, the growth rate of revenue has been 20%. That's great. And since COVID, plus 17%. This business is unstoppable. And if you look at the net income, that's not the same thing. Net income has been negative, below zero, below zero, below zero. Yeah. What about free cash flow? Free cash flow. Cash flow has been negative for a while. Yeah, you can't really forecast this. Somebody wrote a message. Oh, you raised your hand.
No, I just have a question, but I'll let you finish.
Yep, go ahead.
No, I just looking at the which website was it? Guru Focus. The P ratio that is on there it's huge, no? Or am I
Yeah.
not seeing properly?
Yes, it's
84.
huge.
It's
Yep.
super expensive. I don't know.
Super expensive because the company is not profitable. I mean, this is look at this is the net income, the GAAP net
yes,
income.
of course.
So
Yeah,
if
okay.
you have, I mean, mathematically speaking,
Yeah, it makes
if you
sense.
have a profit of 0, you have a PE ratio of plus
Yeah, sure.
infinity.
Yeah. Okay.
So that's why the company struggles to become profitable on a GAAP basis. So maybe you don't really want to value it on a PE ratio, but on the price to free cash flow ratio.
Okay.
And here they say price to free cash flow of 24 because they don't adjust for the SBC. Like when we made our small formula, we did some adjustment for the free cash flow. We removed the stock-based compensation, but some websites don't. Okay, so maybe you're not familiar with Stock Unlock. Stock Unlock is great. You have a couple of tabs on Stock Unlock that are very interesting. And I can show you how to use the insights on this one. The way we use the insight score is not to check what is good about the company, but what is potentially bad. We want to check what are the red flags of the company. We want to check the red. The things that are red are the ROIC. The company is not profitable, so it's normal. Return equity is based on net income, so it's normal. Current ratio is 0.8. Is the current ratio 0.8? 0.8, yes. So it seems like they might have a short-term liquidity issue. Current ratio is if I have to give a definition, is how comfortable are you with your short-term cash and short-term debt? Do you have more short-term cash or short-term debt? In case you have a problem, COVID 2.0, you know how it works. Shares outstanding here, debt to EBITDA, book value negative. Yeah, that's just tricky accounting. NP ratio is high. No major things here. What I want to check for weeks is the evolution of the income statement over time. If we go to our template, we are at this stage. We check Guru Focus. We highlighted a couple of points. Not profitable, diluting shares. The company is not cheap. The company is not producing any GAAP net income. But why not? Why not? Vikram, are you still interested in Wix? No answer, I don't see you. Or you are muted.
Yeah, I'll not invest, but I'll definitely follow it. I'll see it over a long period of time.
Yeah, I mean, if they become a profitable beast, that is amazing. Another example I have for you is, I mean,
so actually the problem is not in the short term in profitability. I think it might do good in the short term, but in the long run, right? I don't know, it might get disrupted or this thing. So that is something which I don't know. I'm not sure of. In the short run, it might be okay, probably 1 year, 2 year. But if you're looking at multi-year, like 5+ year thing, so if you use the product directly, then you have a better feel of the product, right? For example, Workday, right? I'm sure that the company will be there for 10 years. But this, I've not used the product, so the feel is not there. And these kind of companies can easily be disrupted. Easily. 5 to 10 years. So for me, it is not I like to at least like have some mental peace for at least 10 years. At least I can predict it. If it happens or not, it's a different thing. But this I cannot. I don't have the conviction that it will for 10 years.
What can be the moat of Wix? Customer retention, I'm not sure. Customer retention, churn rate, any website can do the work.
The main niche that I see after being involved in using it was that it's very user friendly, right? And that you somewhat bypassed the designer, right? And I think that's where they overcame WordPress, which is probably the other player in this industry, right? But like you say, with AI, there's a lot of threat, and I get the main issue from my point of view is the ability for this company to have a good growth rate. But if you want, like, you don't have the track record, so you have to, I think what he's doing now, if he's able to be profitable, right? So that the valuation is consistent and so that you can get a good return, right? Because if he goes back to investing, then you're going to be stuck for a long while.
Yes. I think after we look at the numbers, we will go to FinChat, Copilot, and ask. That's a great tool, the Copilot. That's ChatGPT, but for finance, for stocks. You can ask what are the different competitive advantages. See if we have some good source of ideas over there. But yeah, you have WordPress. You have Shopify, where you can create your own business. You have GoDaddy. I know these three. And the other ones, I don't know them. Hostinger also. Squarespace, I don't know. I don't even know if this is a public company. I don't think.
It's an old company, but I don't know. WordPress.
Okay, anyway. Now we are at this stage of the analysis. If we say we like the numbers because it's a growth company, maybe it will become sustainably profitable. So, okay, analyze the numbers with Stock Unlock. You have the insight score, which we just did. We found no major red flag. Maybe for the other weeks, we will find more red flags. And the free form tool. So I will show you how it works. Just for comparison, some businesses can be unprofitable for years and then become profitable and generate a lot of free cash flow. Spotify is the perfect example because Spotify generated for the first time ever their first year of being profitable and generating a lot of free cash flow. Look at Spotify. This is the revenue. This is Spotify. So you all know Spotify, music, playlist, etc. You pay a subscription, a recurring business model. Revenue up and to the right. Net income shows a different story. You see one line of green here. Okay. Same thing for the free cash flow. Free cash flow has been positive, but volatile. And now a lot of free cash flow. If you look on the quarterly basis, you have the same story. Same story that we have 4 weeks. Unprofitable, and then you become profitable for a few quarters. Similarly to the free cash flows. You burn free cash flow, and then boom, you somewhat become profitable. They still issue. So it's possible. And the stock enjoyed a nice rally since the company became profitable. You want to be invested in this one before it becomes profitable. Another example is Netflix, obviously. You know Netflix. And as they increased their prices, it generated a lot of free cash flow. Okay. Now I want to go to Stock Unlock, Wix.com. We go to financials and KPIs, and we look at the numbers. You have 3 financial statements: the income statement, the balance sheet, and the cash flows. The way we do it is we won't analyze all the numbers. That's too much work. We want to spot patterns. We want to spot lines. And this is why I use Stock Unlock. You have the numbers, and you also have this. Look at this. These are charts. You can click on this one, and this will toggle a huge chart. What I want to check is this chart. Total revenue, I see no major ups and downs. Okay, this is, we already checked it on the free form tool, so we confirm it. Okay, you have CAGR of plus 35% per year. Look at it, cost of goods sold, look at this. Boom, you see that's this, it's a different chart. you have an exponential curve for cost. So cost of goods sold, the cost of running your operations. What's the cost of goods sold for Wix? When you have a question like this, you can either go to the annual report and you will have in details a paragraph, the annual report, quarterly report. Maybe we can ask the copilot, what's included in the COGS of Wix.com? Because it takes some time to go to the annual report. I mean, you have a website, so some of this is the SBC. Acquisition-related expenses and amortization. I don't buy this. No, I don't buy this. Okay, well, I have to go to the annual report. This one, quarterly results, press release. You scroll down, I want a big table. Okay, the cost of, yeah, we confirm that they have two business segments. One big boy, recurring, and the other one that is not recurring. Cost of revenues. Do they include what's in their cost of revenues? Share-based cost of revenues. No. Okay. That's the price of hosting their website, I guess. You have a little bit of DNA. Depreciation and amortization, guys, you will see that in the videos. Sometimes when you make a huge acquisition, you amortize it accounting-wise. You don't want a huge bump to your net income, so you amortize your cost over several years. So that's a cost over several years. And the depreciation and amortization, DNA, is included in the cost of goods sold, so cost of revenue, and also in the operating expenses. Impairment. So maybe that's this one. You have a little bit of cost, amortization, same thing for the SBC, and the cost of hosting the website. Okay. What's the gross margin of this business? Metric, gross margin, 80%. 80%. The gross margin has been declining since 2018. Why? Why? Okay. Okay, let me go back to the income statement. You see an exponential growth over there, and then the costs have stabilized since 2022. Shows some efficiency, by the way. It shows some efficiency. If you can reduce your costs, that's nice. The gross profit has been amazing. I mean, that's wonderful, plus 30% per year. Same thing for the cost of research and development. Seems like, as we said previously, in 2022, you had a slowdown in the tech sector. You had to fire a lot of people and cut the fat of companies. Seems like Wix stopped all the expenses, all the growth expenses. In 2022, they stopped spending as much. Okay. What about this one? Selling, general and administrative expenses. So administrative costs, salaries, for example, and you look at this again, in 2022, you fire a lot of people, you reduce your workforce, and you reduce this cost. I'm guessing that the operational margins, EBIT margins, increased in this period. So, okay, some efficiency. If you want to go and say and do a deep dive on this one, you can check what happened here. Maybe check the investor presentations in 2022, because you will have some great data over here. I mean, they completely stopped spending. If I check the metrics, operating margin, operating margin in 2022, EBIT margin was minus 30%. And they say, no, we will stop spending as much. Let's fire a lot of people. And now they became profitable. Another question for you guys. If they go back to growth mode, they will have to hire more people. They will have to increase the cost of goods sold. Do you really think that margins and profitability will be sustainable in the future. If they go back to growth mode, they will go back and be big on costs, and maybe all the margins will be decreased and will crash, and we will go back to seeing red and red. That's a good question. I don't know. Look at this. This is your EBIT, operational income. So your revenue minus the COGS, minus the salaries, minus the administrative, minus the headquarters, blah, blah, blah. It was negative. And then, wow, okay. Like 2022 was a big turnaround play for them. Okay, let me continue. Net interest expense. It's insignificant. We are talking about small numbers. Also, guys, another quick tip. Don't look at all the numbers. You see, the goal is to see what is moving the needle. Revenue is, let's say, $400 million. Okay, so don't look at this. This is less than 100. We really don't care. The goal of Stock Unlock is to check what really matters. What are the big numbers? This, too small. This, too small. Income before tax, okay. Income tax expense, too small. I really don't care about this one. So, okay. After this, everything is bottom line. Diluted shares outstanding. They have been diluting shareholders, like more shares and more shares, on average 4% per year. So if you were a shareholder of this business, you have been diluted 4% per year. Earnings per share is a complete mess. I have strong doubt about the profitability, about the sustainability of the profitability, by the way. Because of this, we clearly have a change in direction since 2022. And if the business goes back to growth mode, I'm afraid the profitability will completely collapse. Something we didn't see on the investor presentations, strangely enough. Okay, let's go. Do you have any question, or we can go to the balance sheet? No. Is it good for the moment? Okay. What do we have in the balance sheet? Balance sheet is what the company owns: the assets, the patents, the cash, the inventory, blah, blah, blah. And then the liabilities are what the company owes to somebody else, like the debt, the short-term inventory, the payables, what you owe to somebody else. Okay, let's start with the cash and cash equivalent. The company always had some cash, and the cash pile is growing. There is nothing we can get more than this. The cash is $600 million. And this is a company with a market cap of $10 billion. Okay, that's what, 6% of the company is in cash? Okay. Short-term investments, 800. Okay, we don't really care about this one. Short-term investments is when you have too much cash in your balance sheet. If you are a company, you don't know what to do with the cash. Either you can do like Warren Buffett and invest in treasuries, in bonds that will have a yield of 4%. Okay, very well. Or you can do small other hedging or some stocks, some different kind of bonds. But basically, you have to sum this up to get the cash. Short-term investments and cash equivalent. So on the latest data, you have $1 billion of cash. Can we check on Grow Focus? $1 billion of cash. Yep.
Just theoretically, like when you have too much cash like this, and you have to invest because it's not the best to have all your money or the value of the company in cash. Why don't you repay the debts if they have so much debt? Well, they had some debt to repay. Why won't you go and repay the debt first instead of investing it?
Two scenarios. So you want to talk about the balance sheet. Imagine you have cash in your balance sheet, and the interest rates of the world right now, I mean, in Europe, that's 2.5. In the US, that's 4%. So you can invest your cash and get 4%. Wonderful. Well, how can I write this one? Now, what is the cost of your debt, basically? If you have a cash of 4%.
Okay, it depends on the cost of your debt, basically.
Yeah, if you got debt in 2020, the interest rates were at 0%. So easy money. Why would you repay your debt that will kill your money? You will burn cash, or you can pay around, get your 4% interest, and wait as long as possible, get your interest on the cash, and at the last minute, you pay your debt. It's a matter of opportunity cost. Now, there is another scenario where your cash gives you 4%, and you have a debt for some reason it's at 5%. Oh, in this moment, you pay your debt as fast as possible. You pay your debt. This is a matter of priority. And actually, that's a little bit advanced for your first Thursday, guys, but I like it. You can check what is this percentage of the debt. If you go to the annual report of the company, where my annual report, you can check what is called maturities, or you can even ask the Copilot, what are the maturities and percentage of interest for Wix.com's debt? You can, the maturities is when do you have to repay your debt? You have to repay your debt in 2025, 2026, 2032, and what is the percentage, the yield of the interest rates of the debt? Two things. So it depends. This allocation of cash is a good question. If you can have a 4% yield on the debt on the balance sheet, maybe it's better to keep it. Unfortunately, I can't find this information. Okay, let me just quickly look at the annual report, and if I don't find it in 2 minutes, we will do something else. Annual and quarterly reports, PDF, Nasdaq. Let's take Control F, maturities. No. Here we go. This is the leases they have. No, this is the maximum amount information we have. This is the debt securities. I think that's this one. What's the interest rates? That's around here. Marketable securities. No. What is the debt? Around $1 billion. Oh, $1 billion. But that's around here. I don't think we have the time. I'm lost with all these tabs. Okay. They don't give us the percentage. Average discount rate 5%. It is this one. The way average leasing remaining lease term and discount were as follows: 5%, 4%. Debt. Okay. Normally, you have a big table with all this information. Amortized debt, fair value, net carrying amount. What do I see? Do I see an interest rate of 0.5%? Okay, convertible notes. If the cost of interest rates for the debt is 0%, you have to never pay your debt. Yeah, you get my point. Okay. Let me continue. Okay. So it was for the cash management. Seems like they are quite happy with the cash they have. They have cash that is sitting on the balance sheet, and they have short-term investments, bonds. Net receivables, nothing to see here. This is minimal. Don't spend your time here. Look at this. Assets, like what the company owns, is $2 billion. And net receivables is 50 million. You don't care. Just skip it. Skip this, skip. This is not. What are the big lines? Property, plant, equipment. What is the property, plant, equipment for a software company? $500 million. Seems like this is what the company is investing a lot. Okay. Goodwill. Goodwill is when you make an acquisition, guys. Goodwill is the difference between the assets of the acquired company and what is the price paid. Imagine you have a company, the assets of the company is $1 billion, but you make a bid, you make an offer to acquire them at $2 billion. You have a surplus. 2 minus 1, that's 1 billion. 1 billion, where do you put it in your balance sheet? That's not an asset, that's not cash. It's called goodwill. This is the surplus you have when you make an acquisition. So you can see where did Wix made the acquisition. They made an acquisition in 2017 and made an acquisition in 2021, basically. Okay, nothing here. What's the current debt? Current debt seems to be new. Okay, $500 million. I think they have no problem with their debt. We said that the current ratio was below 1. Okay, maybe a short-term liquidity. I think they have zero problem of liquidity in the short term. Okay, so not much information in the balance sheet actually. They have cash, they have a little bit of debt, but as you saw on Guru Focus, guys, look at this. On Guru Focus, we have $1 billion of cash, $1 billion of debt. That's fine. Don't spend time. Don't spend even 5 minutes on this one. Cash flows. Oh, this is where we will get some information. How do you cheat on your cash flows? How do you cheat? Well, how do you start from a negative net income and how do you make your free cash flow? So you start from net income, right? That has been negative, negative, negative. And then for some quarters, because you stopped the costs, you make money. SBC. So much SBC. SBC was $70 million in late 2021. And similarly to the costs, they stopped issuing more shares. Well, they issue $60 million, but the growth has stopped. Okay, this is insignificant. DNA is insignificant. Other non-cash items, I don't know what that is. Change in working capital, insignificant. Property, plant, equipment. This is the CapEx, the capital expenditures. So when you have cash at the end of the year, you produce some cash flows from your business. This is the cash that you reinvest in the business. You build new facilities. You have a new plant in Mexico for some reason. This is this line, property, plant, equipment. And you see that, I mean, in 2022, 2023 were years of reinvestment. Okay. And the peak was $70 million of CapEx. Very well. Debt repayment, they don't want to repay their debt, and I understand them. Stock issue, they start to do some buybacks. Okay. And that's the free cash flow. So free cash flow was negative in 2022 because of high CapEx. In case you don't know the formula to get the free cash flow, to get your free cash flow, you have operating cash flow. So this line here minus the investment in property, plant, equipment, minus the CapEx, the new facilities, warehouses. So what was the the operating cash flow in 2022? It was almost zero, okay? And the CapEx in 2022 was minus $70 million. So normally, the free cash flow is 0 minus 70 million. You have this, minus $70 million. Okay. And since 2022, it seems like they stopped the investments. They stopped the CapEx, like they completely reduced. So since 2022, we said they reduced the cost of goods sold. They reduced the research and development. They fired a lot of people because they reduced the SG&A cost, administrative. They reduced the marketing cost. They reduced the property, plant, equipment. So yeah, obviously you make money, you cut all the costs. Okay. Okay. And our question remains valid. If they come back to growth mode, I mean, you have two scenarios. Either the company goes back to growth mode with a lot of costs, and then profitability will completely collapse, or they become efficient, and maybe they don't need all these costs. And maybe the company can keep on growing without all these costs, like Meta Platforms, Facebook. They do it, for example. We have the same change in 2022. In 2022, they completely cut all the fat of the company. They fired a lot of people, but they have continued to grow. And for weeks, the growth rate of revenue was 13% since the change, let's say this way. Pretty good. Pretty good. Okay. About the metrics, what can we find? Gross margins are still high. I think this is sustainable, around 70%. SG&A completely collapsed because they stopped the cost. Net margins, I mean, we don't produce revenue. Free cash flow margin. When you have this kind of charts, you can't really forecast the future. Like, depending on the reinvestment phase you are, how can you forecast it? I wouldn't forecast the growth rate of up and to the right like this. I don't think this is sustainable for the company. Yeah, and the company is not having much return on invested capital. Yeah, if you don't have real profitability. This is a company that needs to adjust their numbers because on a GAAP basis, they are not profitable. Look at the net income. Maybe this profitability is short-lived. That would be my main worry if I had to invest in Wix. Maybe the profitability is short-lived for all the reasons, for all the 4, 5, 6 reasons we highlighted. Okay, so if we go back to our template, analyze the numbers. I think you can figure out now if you like the investment or not. Again, Vikram, you will monitor the company, but not invest in it. Okay, imagine you don't like the numbers and you say, oh, that's too complex for me. I'm not sure. Maybe the profitability will go down in the next 2 years. I think they don't have a real moat for some reason. It's a pass. Don't much waste time on this one. If you still like the thesis, if you like the idea, and if you think that the company can grow but more efficiently with the lower costs, you can continue. You can continue, and you can what's written here. Add to the watch list, like exactly what Vikram is doing right now. You add to the watch list and you monitor it from a distance. What are the next steps? Does the business have a competitive advantage? Now this is back to your step 1 here. Do you understand the business? If you do not understand what they do, what they sell, you will not be able to answer this question. So quite tricky here. If we do understand the business model, how the business makes money, you can try to estimate if they have a competitive advantage, right? So if you are familiar with their products, you can automatically say, yes, they have a moat. If you think AI will be a threat, you can directly assess the situation. Either you know the business, or another way to check if a company has a moat is to check other articles on VIC, Value Investors Club, or Seeking Alpha, like people that have written some research. Or you can go to the annual report, and the company will give you hints of what their moat is. A competitive advantage. Okay, look at this, and you have some hints. Spoiler alert, a lot of companies will say that they have a moat, they have a competitive advantage. The goal is to attract investors, but they will give you some hints, elements. We may face significant competition from a company that enjoys potential competitive advantages. This one, greater name recognition. Oh, they talk about the threats of competition in this paragraph. And they say what matters in their industry is greater name recognition, longer operating history, more extensive commercial relationships in certain jurisdictions, substantially greater market share, larger existing user bases, substantially greater financial, etc., etc. Okay. Drive competitive. What's the moat of this one? And also, what's the competition for this one? Who are the public competitors to Wix.com? If this business turns out to be in your circle of competence, you already know them. Like Shopify is good for small businesses. GoDaddy, this one.
So it's giving all the Israeli ones.
Yeah.
So there should be international ones are more prominent, right?
Yeah, I think this is wrong.
Yeah.
I think this is wrong. What's this one? I mean, if this is Guru Focus. Matrix, that's a cool name. Matrix IT. What do they do? Software solutions and value-added services in Israel. Nothing to do with websites. Great chart. Okay. No. So in this case, FinChat is not helpful. You can say, what are the competitive advantages of Wix.com? And in the meantime, we can go to VIC. type Wix, you have one article that was written about Wix.com in 2022, or you have to log in. Oh, why am I disconnected? Many times I have this problem. You just have to log in. It's completely free. You can create an account and you can read the article of somebody that wrote some great stuff, analysis, and they will maybe talk about the capital allocation, competitive advantages.
So at one time, the Pat Dorsey had like 20% allocation. Probably the price went up and then he reduced.
Yeah, from Dataroma, this is what we had.
Yeah.
Adding, reducing. I mean, he trimmed a little bit, sold a little bit. Wix, he reduced by 2%. He reduced by 25% in Q2 2024. He reduced by 40% in Q4 2023. So it's been a changing investment for him. And look at this. In case, I don't know, maybe Charles, I don't know if you are familiar with the VIC. This is a great website, and people write analysis of companies. So every time you research a company, you can go to Value Investors Club. You can create a website that's completely free. Type the name of the company you're interested in, and you will read the brain of somebody that wrote a great research. There is a high bar to write on Value Investors Club. Most articles are rejected. So you only keep the best articles. And you see, all the articles are great. And I can put it in the Google chat. That would be, in case you want to save it and read it later. That is interesting. And you will have something. 20% of his portfolio for Pat Dorsey. And they talk about this, boom, boom, boom. You have 3 parts. DIY web building market. They talk about the different segments, the moat, etc. And Shopify. The second is commerce segment. Here they compete about Shopify, Square Block. Finally, there are some more e-commerce platforms significantly more focused on. These are the competitors. Shopify is a competitor because Shopify helps small businesses. And then there is Editor X. Okay, like an editor tool. Do they talk about the moat? You don't have any paragraphs, like big names in bold. So let me type moat. Competitive. The pricing power. E-commerce. This is great. Sometimes you don't even have to spend hours on a company. Sometimes people give you the playbook. Shopify. They talk a lot about Shopify. Interesting. Okay. If you want to know more, read this one. You will have some information. If you want to know more about the competitive advantages, you will have some articles written about this one. I don't know the competitive advantage of Wix, so I will not be able to give you this. But sometimes you get some information in the annual report, sometimes in the investor presentation, or sometimes you can just Google it. Competitive advantages, Wix.com. Funny. You can have Quora, you can have this. For companies that I don't understand, I usually just go online and see what other people are thinking about the business, if you really have a moat. The problem I would have with Wix is how competitive you are with your pricing. Kenneth, you talked about the user-friendly atmosphere, but a lot of companies can have a user-friendly website. So this is not a real moat. And AI is definitely a threat to their business. Will websites be able to replace web developers? You have plenty of reading over there. Penetration expansion. You have articles from 2013. That's amazing. Basically, if you are a small business and you want to build a website, where do you go? And I suspect we will see much more competition in 2025. WordPress, this one, Wix here, Wix is here. Squarespace, I don't know this one. And Shopify, which is known to everybody. Okay, interesting. Okay. And then, I mean, I see almost no moat for Wix. The only moat I can see for Wix is the name, the brand recognition, and the simplicity of their products. And that's basically it. But if there is a great new company that comes out of nowhere with AI, people will shift. You see how people quickly shifted to Canvas instead of Photoshop. Canvas is easy to use, user-friendly, and very appealing to the younger generation. So new solutions can really come to you. Okay. And if we go back to our template, if we say the company has a moat or no moat, maybe it deserves a discount or not. And let me finish with the valuation. Oh no, before that, I want to check what's the insider ownership of this business. You have Wix, right? Ownership of this business. You have the co-founder and CEO that owns, look at this, 2% of the company. Decent, not exceptional, not bad, decent. The CMO owns 1% of the company. The president owns 0.5. That's fine. So you have an okay insider ownership for this business. Who are the holders? Yeah, big funds, right? Owns this one, Billy for 10%, Blackford 5%. Okay. Dorsal Capital Management. Is it Pat Dorsey? I don't think so. That's Dorsey as management. No. I don't think that's the same thing.
How much does Pat Dorsey own in dollar terms?
That's a good question. We have here holdings. You have Wix shares. He owns this amount of shares at this price. That's a value of $120 million. So that's 1% of the company, 1.2% of the company, roughly speaking. So normally he should be around here. 1.5. Oh, I can't scroll down anymore. Wix.com, insiders, ownership. These guys owns 2%. If I scroll down, I want 1.2%. The CEO owns 2%. Dorsey. So yeah, roughly 1% of the company is owned by Pat Dorsey. Pretty good. Pretty good. Okay. Okay. The only thing that is not included here, but we already talked about it, is the capital allocation of the company. We mentioned the cash management. We mentioned the dilutions over the years. Look at this. You have dilutions for many years, and now you have buybacks. You have the debt. No problem with the debt. The balance sheet is fine. Do you have a dividend? No, you don't have any dividends. If I go to the dividend tab, dividends, no dividends, never. Focus on growth. About capital allocation, what did we say? We see that in 2022, they fired a lot of people and became leaner with the heavy investments, and then you stopped a little bit. And focus on margins, focus on growth, focus on retention rate. The only question mark I have for this business is, at which point do you become sustainably profitable? What's the cost structure if you are profitable? And do you really have a moat? That's my two big question marks. I don't know for you guys, but that's the key things that put me in a difficult situation to invest in Wix.com. What's the moat in the next 5 years? I think they don't have a moat. The brand, I mean, Shopify also has a brand. Come on, this is a brand recognition. Shopify is great. And about easy to use product, everything is easy to use right now, user friendly. I have created different websites on different platforms. No particular change between Wix and other stuff. So that's my two takeaways, but it will change for you also if you think they have a moat or not. Now I want to finish this analysis by doing a DCF. we will talk about valuation. How do you do valuation for a business that is not profitable? You will have a PE ratio that will be 0 and then plus infinity. It will be that will be too difficult. Now the PE ratio is 80. I mean the company was never profitable. I don't recommend to look at price to book. I don't recommend to look at price to sales. I recommend to check PE ratio and price to free cash flow. Only two. And the PE ratio, the price to free cash flow over time. And what's that? By the way, what's the free cash flow of the company over time? We said it was decent, right? Yeah, we said small increase and then heavy investments in 2022, and now boom, it released. Okay, so the price to free cash flow should follow this, having a normal price to free cash flow 40. Pat Dorsey bought with a price to free cash flow of 50. Yeah, a bit expensive, but if the company is growing, that's fine. And then 0, and now we are back to a price to free cash flow of 22, 23. Just as a reminder, 22 is adjusted by the SBC, the stock-based compensation that is added back to the free cash flow. Same thing we did like 1 hour ago with the free cash flow and the stock-based compensation. So maybe you want to reduce this, and back of the envelope, we said right now, we calculated the price to free cash flow of 35, roughly 35. That's not cheap. That's not cheap. Yes, I know it's a software company growing fast, growing like 20% per year, 30% per year. But this is definitely not cheap. And if we go,
why do you think it's not cheap? What was the reason?
with all the uncertainty we have with the cost, with all the how can I say it, unsustainability with the cost structure, I don't know if free cash flow will be higher in the future. I think there is a decent chance that free cash flow goes down in the next few years. If the company is back to growth mode, higher costs, not focused on efficiency, free cash flow can go back to the lower territory, like lower than $100 million of free cash flow. And I'm not comfortable paying a 35 price of free cash flow without much certainty, without much visibility. If the company was trading at a price to free cash flow of 15, yeah, why not? Maybe a 20, yes, why not? 25, yeah, why not? After this, this is not cheap. I'm not saying this is expensive, right? Price to free cash flow of 35 is not crazy expensive, but that's not cheap. Let's say it's fairly valued, the minimum, but this is not crazy cheap, not at all. What has been the revenue growth rate over the past, let's say, 10 years? 10 years, revenue growth of 28%. This is phenomenal. And since COVID, 18%. Okay. And since 2022, the 11%. Seems like the growth rate has stopped when the company has become more efficient. You can check this here. If you go to income statement, total revenue, percentage change, you see this. In blue, you see the percentage of change, the revenue growth rate. Before, the revenue grew, what is that? How can I see the smoothest chart? This one maybe? Okay, let's go for this one. Before, the revenue, is that on the year-on-year data? I'm not sure about this one. Revenue year-on-year. Let me put this one. Before, the revenue was growing 80% per year. It was a small company and you need to get scale, right? Just in as a business perspective, when you grow your revenue at 80% per year, you don't care about being profitable. You just take as much debt as possible. People gave them money because that may be the next Facebook. So you don't really care about short-term profitability. In the private equity world, you just give them money because they are growing really fast. You will see efficiency later. And now in 2016, they only grew 45%. And now since COVID, growth rate of 30%. And during the efficiency mode, they only grew 10, 12%. My other guess is when you cut your costs, it has had an impact on the growth rate, like a large impact on growth rate. So I don't think the company can grow 40% per year, like in the past, if they don't increase costs again. The lack of cost was a big drag on growth rate. So depending on what you think the company will do, you can invest or not. If you think the company will go back into growth mode with more costs, you can expect the profitability to completely collapse. But there will be a growth story. If you think that the company will not grow again, like a lot, if you think the company will stay efficient like this and focus on buybacks, free cash flow, net income, they will only grow 10%, 15%. How can you answer this question? You can answer this question if you listen to management. You can go to the investor relations, earnings calls, and you have the quarterly updates, right? There is a report here, some questions with analysts. If you read 2 or 3 calls, if you listen to 3 or 3 calls, you will get a sense of what's the goal of management or the report here. And about the slides, no, not really the slides, no. For example, we can do Control F, focus on the AI assistant and agent. Maximizing the lifetime value of our existing user base. For this kind of business, in the first years, you grow a lot because you attract new customers. But once you have reached a certain size, everybody knows Wix.com. Maybe all the small businesses have an account. So you don't attract new players, new customers. So you have to retain your current customers and increase the prices, like Netflix. Everybody has Netflix, so that's the same thing. Focus on cost management. You see, you will have great data if you listen to these calls. Great data, focus on efficiency. Following the meaningful operating leverage generating over the past 2 years, we remain focused on managing a stable operating cost structure in the year ahead. So in 2025, I don't expect a lot of growth at all. They said it. I expect the cost structure to be the same. I expect costs to be quite low. So I don't think the business will grow 20, 30%. For Wix, okay. Focus on driving growth, careful growth, free cash flow. Yeah, they want to produce free cash flow. Cohort value. Maybe this is a saturated market and everybody has a Wix.com account. Everybody has an account and they just want to increase the revenue per user, the free cash flow per user. So if we want to value this business, you go to DCF on Stock Unlock, and now we will put our estimates. Okay. Normally, when you do a DCF, discounted cash flow, the goal is to find an interesting value. You can either use this metric, the free cash flow, or the net income. But because net income is a mess and unprofitable, negative, we will use the main one, free cash flow. The company is talking about free cash flow. Let's use their language. In the past 5 years, the company has grown the free cash flow by 30%. But look at this chart, guys. 5 years, what was? We are in 2025, so 2020. The starting point of this 30% per year is this one. Well, it's a roller coaster. So based on everything that we have said, what we just read on the earnings call, I'm asking you this question. What will be the growth rate of free cash flow over the next 5 years? What do you think?
Probably give 20% as a good number with a margin rather than 30. It's too high.
Yeah, I agree. 30 is too high. Too high. Let's say the company is not issuing shares anymore. Let's say the company is not doing buybacks anymore. And what is a good price to free cash flow for this business? That's a good question. I mean, if I look at the price to free cash flow, on average, it's a mess too. It's too hard to find an average. The average was 70, but you have this. The company was at 35. The goal is to try to find an average. Since they went into efficiency mode, it was like this, 40.
So 35 is around 30 is a good number, I think.
Yeah.
Because for a software company, like 30, 35, you can play around with it, like 30, 35 plus minus something.
Should we adjust for the SBC?
No, ignore it, because we are doing assumptions, right? So we just not do it.
Yeah, 35 is a lot still. I can put 30.
Yeah, 30
Right,
is also.
because what would be the growth rate? I mean, we'd have to go into calculate, but what's the growth rate of the free cash flow without the SBC?
Can we have it? I think we can have it. Let me go to Insight. Or maybe we can put here free cash flow without SBC. Come on, free cash flow excluding stock-based compensation. Thank you, stock unlock. That's great. Okay, so it follows the same pattern of being positive and then negative and back to positive. Good luck, Kenneth. What's your growth rate here?
Negative, right?
That's horrible. How
it's flat, right?
over the past 5 years, it was 18, and now it's 0. It's at 0 now on a quarterly basis. 5 years ago, 5 years ago, it was 7, decreasing up now, and now it's at 0.
It was 7 is the growth, right?
7 is the free cash flow, excluding
per quarter. That doesn't make sense because we were at 70, right? For quarter times 4 was 280.
Yeah, this is for 2020, so 5 years ago.
Okay.
Now, if you look at the latest data, you are roughly at 70,
okay. Gotcha.
70 million.
But it was flat at 7, and then it went up, and now it's at 70, and
yeah, that's so hard to forecast. So hard. I don't even know how to forecast this one. The chart is impossible to predict, right? Either the company can go back down. Maybe we can use some help from Guru Focus on here, but I don't see how we can forecast.
Can we use revenue?
Revenue was around 30, right?
Yeah,
35, I think. But so we could be lower than that, which was 30, right? It's between 25 and 30, something like that.
If you look at the past 10 years, the company was in growth mode with a lot of costs, okay? And the revenue growth rate was high, like 30%. But do we really want to extrapolate this? Now the company is in efficiency mode and the growth rate for revenue is only 12%. Somebody's trying to join. Oh, wonderful. So should we really take into account 30%? Now the company clearly said we are in efficiency mode. We grow 12%. Hi, Mika.
Right, because the only data that you have, because you said 70 for now, and 1 year ago it went up very strong, so it's very difficult. I have no idea.
Yeah, this is a rebound. Mika, we are analyzing the company Wix.com. Maybe you are familiar with this one. This is a company to create websites. If you are a small business, small like Shopify, this kind of stuff. We are at the end of the analysis. We are the DCF part.
No, we said I'm just listening in.
Good, great. We said the revenue growth rate was nice, but the company is now focused on cost and free cash flow. I mean, actually, if you want to be conservative, guys, for the free cash flow growth, I could put 12%. That's a different picture. Look at this. If we say they deserve a price to free cash flow of 30, and we say, yeah, go ahead, Charles.
Sorry, where do you get this tab on the website to do the valuation?
On Stock Unlock?
Yeah.
Okay, that's here. I go to Wix and go to DCF at the right here.
Okay. Thank you. Sorry.
To go to the free form that's just here. Free form is where we look at the compound annual growth rate, this kind of interface. DCF is just at the right here. Okay. And okay, if we want to be conservative, if we say we are aggressive and we say, okay, they deserve a price to free cash flow of 30, they will grow 30% per year. That will never occur. It will never go. In this case, that's a triple. That's a triple. If we are a little bit more conservative, like Vikram, and we say, okay, it can fairly grow 20%. In this case, that's a double. Maybe that is what Pat Dorsey is looking at and saying, yes, I think it can grow 20%. If we are a little bit more conservative, we'd say it can grow at 15%, which is not unreasonable. I mean, now, during the first years of efficiency since 2022, the business has grown 12%, the free cash flow, or the revenue. But maybe they can improve on this, 12%, 13%, 50%. I mean, that could be some good assumptions here. And if you think they deserve a price to free cash flow of 30, you can get some almost double.
Guys, I'm going to have to run. I'd like to thank you for today. Learned a lot of homework.
Yeah, that's great. Thank you for coming.
But it's moving forward. So thanks a lot. Have a good day to everybody. Bye-bye.
Thank you. You too. Bye-bye.
Bye.
If you want to become a little bit more conservative, I mean, just so you know, Vikram, if a business is growing a lot, they deserve a high price to free cash flow. But if the growth stops for some reason, maybe they don't deserve a price to free cash flow of 30. You know how it works. You know how it works for, you have Chipotle, you have Amazon, this kind of stuff, multiples matter. Same thing for meta platforms. Like at the time, the PE ratio for Facebook was 15. People said, yeah, it's not a big grower, and now the PE ratio is 30. So if they only grow by 12%, let's be very conservative, okay? Let's say it will continue at a slow rate, which is quite decent. I mean, 12%, that's okay. In this case, that's a fair value at plus 50%. So it's good to buy right now. But maybe the price to free cash flow of a slowed down company is 20. In this case, that's fairly valued. I think either the company is fairly valued or it's cheap at the moment. Based on that, I would not invest in Wix first as competence and the moat and the growth rate and
so for me the major problem is like, how do I stay invested for many years? I'm not sure, right? There are so many competitors. I don't even use the product. So if you're using it, then there's a different conviction. So
that's true. If you use it, you know if you have to switch to another website or you stay with Wix. That's true. If you are a small bit, I don't use Wix right now. I used it like 1 year ago, 2 years ago, but not anymore. So I don't really know. But then maybe this is what Pat Dorsey is saying. A business that can stay efficient, grow 15% per year, they will have a decent multiple, and you still have upside. And you know what? They reached this kind of price not long ago. They can go back to this price. It's not magic.
And probably he invested it at a very low price, so he can stay invested for a longer time, right?
Yeah, we said that he invested in 2018. The price in 2018 was here at $60.
Yes, it's already 4x now, right? So probably he already sold something, so his capital might be out. So it's just the gains.
Yeah, it's 200. It's a triple for him. It's a triple. Interesting. Well, thanks for the recommendation. Thanks for the suggestion. That's good. Okay. Yeah. Maybe in case, Charles, you want to go deeper into this one, you can, in case this is interesting to you, in case it is not, you can move forward and analyze other business. But you have this VIC article here. You can check who are the competitors of this one and check the earnings calls. Either you can read them really fast or you can listen to them, look at the slides. And I would be very curious to see what has happened in 2022. Like go back to Q4 2022 and see how they are suffering. Like it's a complete 180-degree turn from being a fast growth company to become lean and efficient. That's that's a big change in strategy. If I type focus here, focus, increase finding efficiency, cost, operating efficiency, general prudence across the business. The tone is very different. Efficiency. You know, for meta platforms, Mark Zuckerberg called 2023 the year of efficiency. So a lot of tech businesses had this. That's great. We are defocusing our thinking about net ads. Net ads are new clients, I suspect, and focusing so much more about the absolute value in the cohort itself. So they shifted from new client acquisition to increasing the value per customer. Yeah, or everything that we said for 2 hours, this is confirmed here. You have all our guesses were justified. Maybe another thing, if you want to continue the analysis, is to check their 3 segments, like creative, business, and editor, and see which one is growing the fastest, like the growth rate. You will see this on the slides. Just to see. We know that the creative is more recurring with better margins, but is this a new business? In 2022, you already had the creative and the business. Even in 2020, you already had these 2 segments. What I try to say is it's not a new segment that came out of nowhere in 2023. It was there. And even in the past, it was like 1/4 of the total revenue. If it was a business segment that was 25% of the revenue 5 years ago, and now it's still 25% of the revenue, the split is the same over time. So I don't think this business is growing faster. I think the 2 business lines are growing at the same rate, but at a different margin. Consistent value. Yeah, the investment for this is quite simple here. A few questions, but that's fine. RRPS, is that the average revenue per subscriber? This is what Meta Platforms is using also. Like you want to increase the value per customer, the revenue you get out of customer. You increase your prices, you have more offerings. The goal is to become more efficient. For each customer they have, they want to increase the revenue. Need to drop, see you tomorrow. Bye-bye, Vikram. Thanks for the suggestion. So that's good. I mean, their plan was pretty good here, and you can check how it worked out. Amazing. Okay, Charles, do you have any question?
No, I think it's very interesting to see the whole process. I like the valuation part, to be honest, because I have no clue. You know, like right now I have some stocks on the watch list, but to put a price on it is difficult. So thanks for that. But to be honest, the Wix business, I don't like it that much.
Okay, that's a quick pass.
Yeah, it's I don't know. For example, I know WordPress. I used to use WordPress. My brother built his company on WordPress, basically. And I don't know. I think it has it's quite easily disrupted. You know, it doesn't have. To me, the moat is really missing. You know, I don't see it. Maybe it's the size of it that makes it so much bigger than the other competitors, but or maybe it's the time they. I don't know what it is really, but I think it's a bit too. I wouldn't say risky, but I don't know. I don't see it as like an investment for the 15 years ahead. I don't know. Like to build a website is nowadays is easy. You know, like I mean, you don't need to code anything, and you even have ChatGPT. You can just write, build me a website, and it probably will do it like quite easily. You know, so I'm not sold on the business model or the moat.
No, you can.
I prefer Otis. You know, like
Otis is simple. Otis, elevators, security that will not be disrupted by AI. We need the maintenance of the product.
Exactly.
Yeah.
But yeah, very interesting though. It doesn't mean that it's not interesting to see how you look at this with everybody. It's very good to listen to this.
If you liked this video and you want to go deeper, I've created a free guide called How to Outperform the Market with a Proven Investing Strategy. Inside, I show you the exact method that helped me generate 25% per year, including how to build a framework you trust, how to find great stock ideas, and how to build a winning portfolio. It's the same process I use for my own portfolio, and it's 100% free to download. Comment guide below or click the link in the description to access your free investing guide. Just go down there, click the link, follow the instructions on the next page, and I will email you the guide 100% for free.